We're going to talk real quickly about why the 1% rule needs to die a terrible death. Now, this was one of those kind of like litmus tests that used to be really popular. I'll be honest, my second one was one. I'm all into a property for 118 grand, I'm getting 1,200 a month in rent. If you're going by the 1% rule, I'm going to show you exactly how that looks like based off of actual financials on a property that we own. So on this particular deal, we actually bought it for 108 grand. We ended up spending about 8,300 in contractor costs. We had a little over 1,000 in holding costs during our construction phase. We had right at about $500 in utilities during construction as well, and then like $50 in trash. All in all, our remodel and holding costs prior to lease up cost us right at $9,900. So we ended up into this thing for 118 grand. Now, from an equity perspective, we're doing really, really well. This property has already been cash out refinanced. We were able to totally burr all of our existing capital out. By most standards, this is a decent deal. Now, that being said, I'm going to show you why I'm not super thrilled about it. So the property as a whole in the past 18 months has pulled in $20,400 in gross income. Not too bad at all. We've got $1,956 in property management. Now, we do all of our management in-house. However, there are still expenses, so we still bill at 10%. You're not really going to save any money by doing it yourself. You're just going to control the experience of your residents and therefore make sure that you're keeping people as long as possible. So we had right at $1,956 in holding costs, had $1,060 in insurance, had $283 in HOA dues. This is a nicer subdivision and a pretty good school district. We had right at $500 in maintenance. This is like, I think, a garbage disposal, kind of some odds and ends. We had right at $2,100 in property taxes. We had $87 in water and sewer that we ended up paying. We had $21 spent on signs to market the property for lease and kind of get all of that done. So all in all, in total, the property has had $6,000 in expenses in the past 18 months. Now, our NOI is $14,384 for the year. Not terrible, but our mortgage payments were $14,035. Total net income deposited to us was $349. Now, you break that out monthly, and this is retirement numbers here. It's $29 a month in cash flow. Now, realistically, if you take out our management fee, if you are doing it yourself, if you're paying yourself that, it's $128 a month is what we've been cash flowing. So not terrible, but if you're paying staff to manage, or you're not trading dollars for time, which is something you shouldn't be in the habit of doing anyway, you're only making $29 a month. Now, there's a second lesson from this property. And that's, you want to make sure that you do a rental analysis at every release. When we leased the property, we leased it for $1,200, which was about the going rate. The area has been doing well. When we released, we signed for $1,225, so pretty slight increase. However, rent comps are like $1,350. So we missed the mark on the release of not catching, hey, the trend here of rent has gone up quite a bit. So had we done that, that's an extra $1,800 a year in income we'd be getting. So, assuming rent hadn't gone up or anything, and you're paying a property management or you have staff that's doing this, $349 a month or $349 over the course of 18 months isn't that much cushion for anything going wrong. Now, when we buy our properties, we do a good amount of work actually up front to make sure that we're not going to get hit with something like an HVAC or a roof, anytime in the foreseeable future. However, you do still have CapEx, which is kind of preparing for those expenses as they come up. And if you take that into account on this particular property, we're really not making any money. We're maybe breaking even. So that's why I'm not a huge fan of the 1% rule. We now target a 1.25% rent to cost ratio or better, which has served us significantly better. Hope that gives a little bit of insight on why you want to avoid using that as anything more than like a quick and dirty litmus test.